Good morning, children. This is part 6 of the chapter Admission of a Partner. In this video, we are going to study about a new topic in this chapter, that is revaluation account. And as the name suggests, revaluation, that means we are revaluing or calculating the value once again. When is it prepared? A revaluation account is prepared at the time of admission, death, changes in profit sharing ratio, retirement, so that a partner is not able to gain or sacrifice and suffer a loss out of such retirement, death, admission, etc. It means that a revaluation account is prepared whenever a firm is reconstituted. That means whenever an old agreement comes to an end and a new agreement has to be signed in. So it is prepared whenever a new partner is admitted, or whenever any existing partner dies, or whenever any existing partner retires, or when the profit sharing ratio among the partners change. The objective of preparing revaluation account. It is prepared to revalue the assets and reassess the liabilities. What is the objective of preparing revaluation account? The objective is to revalue the asset. That means to again calculate the value of asset, how much is the increase and how much is the decrease, and also to reassess the liabilities. By what amount our liabilities has increased, or by what amount our liabilities has decreased, so that this revaluation is mainly done so that the correct value of asset and liabilities are recorded and none of the partners sacrifice or gain on account of admission or retirement or death or change in PSR. Revaluation account is also known as profit and loss adjustment account. Either we call it as profit and loss adjustment account or we call it as revaluation account. It means the same. Then type of account. In class 11th you have studied that there are three types of account: personal, real and nominal. So revaluation account is a nominal account in nature. Let us study the rule. Because it is an account, it has to be prepared in a T format. So what is to be shown on the debit side and what is to be shown on the credit side? The rule says that debit side of revaluation account shows decrease in assets and increase in liabilities. We are talking about the ledger account. So in case of revaluation account, on the debit side we show the decrease in asset and increase in liability. If the value of asset decreases while revaluing, that decreased value of asset will be shown on the debit side, and if the value of liability increases while reassessing it, the increased value of liability will be shown on the debit side. On the contrary, credit side of revaluation account shows increase in assets and decrease in liabilities, just the opposite. Credit side shows the increased value of assets, if any, and the decreased value of liabilities, if any. For example, if there are creditors worth rupees 50,000 at the beginning of the year, but while admission the creditors become 70,000, so there is an increase of 20,000 in creditors, a liability. So this 20,000 increase of creditors, since it is an increase in liability, will be shown on the debit side to creditors 20,000. So just for revision sake, in debit side in revaluation account, it shows the decrease in assets and increase in liabilities, and credit side of revaluation account shows just the opposite, increase in assets and decrease in liabilities. After posting the increase and decreases on the debit and the credit side respectively, we will have to compare the debit side with the credit side. If the credit side is more than the debit side, there will be a revaluation profit. If debit side is more than the credit side, then there will be a revaluation loss. So whether it is a revaluation profit or it is a revaluation loss, it has to be transferred or distributed among all the old partners in the old ratio. Here we do not have to discriminate or differentiate on the basis of whether they are sacrificing or not. No. The profit or loss in case of revaluation account has to be transferred or distributed among all the old partners in the old ratio. It has got nothing to do with the new partner. So as you can see, the third point, the balance of profit or loss in revaluation account is transferred to old partner's capital account or current account. Capital account if it is a fluctuating method, current account if it is a fixed method in the old profit sharing ratio. Let us have a look at the format of revaluation account. As you can see, on the left hand side you have a debit side, and on the right hand side you have a credit side. As the rule says, on the debit side we are showing to decrease in value of assets, to increase in value of liabilities, to unrecorded liabilities. That means there might be certain liabilities which you forgot to record beforehand. So now you will record. And if you forgot to record beforehand, and if you are recording it now, that means ultimately the value of liabilities would increase, and increase in liabilities are shown on the debit side. Then on the credit side, we will write by increase in the value of assets and by decrease in the value of liabilities. And also we will show by unrecorded asset. Again the same logic. Unrecorded asset means maybe there were certain assets which you couldn't record or you forgot to record beforehand. So if you forgot to record beforehand and you are recording it right now, that means the value of asset would increase, and increase in asset is shown on the credit side. Then you can see the last transaction on the debit and the credit side is profit on revaluation transferred to old partner's capital or current account, and by loss on revaluation transferred to old partner's capital account respectively. So after posting the increases and decreases in various assets and liabilities on their respective sides, we need to compare the debit with the credit side. If the credit side is more than the debit side, it will be a profit, and the profit will be shown on the debit side to balance both the sides equally. It will be distributed among all the old partners capital if it is a fluctuating method, and current account if it is a fixed method in the old ratio. And similarly, if the debit side is more than the credit side, it will be a loss. It will be shown on the credit side to balance both the sides equally, and it will be transferred to old partner's capital or current account depending on the capital method to be followed in the old ratio. So this is the format of revaluation account. Let us have a look at the journal entries related to revaluation account. Sometimes you may be asked to write the journal entries as well. The journal entries are very easy to write or to make. You just have to focus on the basic rules which you have studied in class 11. The rule which was, that is, assets have a debit balance, and if the value of asset decreases, it will be credited. If the value of asset increases, it will be debited. So here in case of revaluation, if, for example, let us look at the first transaction for decrease in the value of asset. As we know, if the value of asset decreases, it will be credited, and any decrease or increase is to be shown on the in the revaluation account. So entry would become revaluation account debited to assets account. The narration can be being or for decrease in the value of asset. So whatever is increasing or decreasing, you debit or credit that, and the other side or other account will be the revaluation account. Similarly, second one is for increase in the value of assets. So assets have a debit balance. If it increases, it will be debited. And if the assets are debited, what is to be credited? Revaluation account. So for increase in the value of asset, the entry will be assets account debited to revaluation account. Narration can be being increase in the value of assets. The third entry, for increase in the value of liabilities. Liability is a credit balance, and if there is an increase in the liability, it will again be credited. So what else is to be debited to make it equal? Revaluation account. And the narration can be being increase in the value of liabilities. The same entry will be for unrecorded liabilities as well, because due to unrecorded liability also the value of liability increases. Then fourth one, for decrease in the value of liabilities. So again, liabilities carry a credit balance. If the value of liabilities decrease, it will be debited. And what is to be credited in order to make it equal? Revaluation account. So the entry for decrease in the value of liabilities will be liability account debited to revaluation account. The narration can be being decrease in the value of liabilities. The fifth transaction, for profit on revaluation account. If the revaluation account shows a profit which is to be transferred to partners' capital or current account. So if we are giving them any amount of profit, their capital or current account balance would increase. That means the liability would increase, so therefore their capital or current account will be credited. And what else is to be debited? That will be revaluation account. So for profit on revaluation, the entry will be revaluation account debited to old partners capital or current account depending on the method of capital. The narration can be being profit on revaluation transferred to partners capital account in the old ratio. And similarly, if there is a loss instead of profit, and if we are giving any loss to the partners in their capital or current account, it would decrease their capital, it would decrease the liability, and therefore the loss will be debited. So the entry will be old partners capital or current account debited. Why? Because of this loss, their capital balance has decreased, the liability of the firm had decreased. Therefore, we have debited old partners capital or current account. And what is to be credited? That is revaluation account. So the entry for loss on revaluation will be old partners capital or current account debited to revaluation account. The narration can be being loss transferred to old partners capital account in the old ratio. So this is all we have discussed about the meaning, objective, and when the revaluation account is prepared, the format of revaluation account, and the journal entries related to revaluation account. This is the assignment based on the topics covered in this video. You have to answer the following questions in your register. Question number 1, when is a revaluation account prepared? So the answer to this question is a revaluation account is prepared at the time of admission or death or retirement of a partner or change in the profit sharing ratio. Full stop. That is whenever a partnership firm is reconstituted. Then question number 2. State the objective of preparing revaluation account. The objective of preparing revaluation account is to revalue the assets and reassess the liabilities so that neither a partner sacrifices nor a partner gains on account of admission, retirement or death of a partner. Then question number 3. What do we record on the debit and credit side of revaluation account? So here on the debit side of revaluation account, we record the decrease in the value of assets and increase in the value of liabilities. And on the credit side of a revaluation account, we record increase in the value of assets and decrease in the value of liabilities. Then question number 4, prepare a format of revaluation account. So for this question, you will prepare the format which we have discussed in this video. That is, this is the format which you will make for the answer to question number 4. In question number 5, state the journal entries for the following. Number A, increase in asset. So here the journal entry will be asset account debited to revaluation account. B, increase in liability. The entry will be revaluation account debited to liability account. C, decrease in asset. The entry will be revaluation account debited to asset account. D, decrease in liability. The entry will be liability account debited to revaluation account. Unrecorded asset, again unrecorded asset, and if you are recording it right now, that means it is an increase in asset. So the entry will be the same as for increase in asset, that is unrecorded asset account debited to revaluation account. Then unrecorded liability, same as increase in liability, the entry will be revaluation account debited to unrecorded liability account. Then G, profit on revaluation, the entry will be revaluation account debited to old partners capital or current account in the old ratio. And H, loss on revaluation, that means old partners capital or current account debited to revaluation account in the old ratio. So go through the video once again, revise the format, revise the rule and the objective, complete all the written work and learn the entries, children. If you understand the logic basically behind the entries, you need not learn them. If you study it conceptually, it will become easier for you. And besides this, do revise the previous parts of this chapter. In the upcoming video, we will be discussing a practical question on this topic. Thank you, children.